Hello and welcome to SN Study Station. So our today's topic is, as you can see, emerging areas in financial management. Okay, so we have covered the topics financial system, financial derivatives, and we have seen introduction, what is finance, what is financial management. Now in this topic, we'll see about risk management, behavioral finance, and financial engineering. These three things we are going to see. So let's start. So introduction to emerging areas. So there are three areas which are emerging. These terms are new. There are new concepts in financial management. Well, maybe you all know about it, but still behavioral finance and financial engineering, these are new terms. Risk management, though, I think you can guess what is it. So basically risk management is related to risk. That means if any business is there, if you are doing any business, then risk will also be involved there. Risk is the difference between actual and expected outcome. What you have expected, suppose you have expectations related to your business, you are assuming that you will have huge profits, but the actual result is different from that one which you have expected. So there is risk. There is always a risk because you can only predict. You cannot actually know what is going to happen in the future. That is risk. Risk management. So that's why its management is very much important. We have to be prepared for the risk. We have to identify what is the risk involved. We have to analyze it properly, and then we have to find out the solution for either to reduce that risk, or we can find some other solution to solve that problem. So risk management is important. It has to be done. Then behavioral finance. Behavioral finance, that as its name says, finance related to behavior or finance based on behavior, means the decisions, financial decisions, if financial decisions are taken on the basis of behavior influenced by someone, if decisions are taken by your mental state, you have thought about something, you have not done proper analysis, but you think that this is going to be true, I will take this decision. This is going to be fine, I will invest in this option. Okay. Or you are influenced by someone else. If the other person is saying that this investment is good, invest your money in this option. So you are influenced by that person and you are investing your money in that. That is behavioral finance. A study of influences of behavior or psychological behavior on the investor. What our mind says to do. Okay, that is behavioral finance, and how it is affected by different factors. Then financial engineering. So it is engineering. That means it is basically designing something, designing some new process, designing some new system, innovating something, okay, to solve the problems. Let's see these three in detail. First we'll start with risk management. So risk management means managing the risk. How we can do that? There's a process for that. First step is identify the risk. First we have to identify what is the risk. Okay, whether that is a financial risk, credit risk, market risk. What is the type of risk which we are going to manage, on which we are going to study. Okay, types of risk we'll see in the next slide. Second step is, once we'll identify the type of risk, then we have to analyze it properly. Okay, why it happened, or what are the factors involved in it, how we can reduce it, what is the solution for this. We have to analyze everything. We have to analyze each and every, we have to study each and every detail about that particular risk, because if we will analyze it, then only we will be able to find some solution for that. Then prioritize. Okay, rank it. What are the risks involved in your business or in anything, in any activity which you are going to do. So if there are various types of risks involved, so rank it. This is the first one, we have to prioritize this, and after this we have to go for this second one. We have to prioritize, then treat the risk. Treat the risk means either you have to reduce it or you have to find some solution for that. Okay, and then last stage is monitor it. The process doesn't end here only by solving the risk. We have to monitor it regularly, on a regular basis, we have to monitor the risk. Okay, so it should not become a huge problem. Okay, every now and then we have to manage. If we are going to do any project, okay, we have to find out in the beginning also, we have to find out, and during the project work, during that activity, we have to find out what are the risks involved in each and every stages. So it should not create any big problem for us. So this is the process and it continues. Okay, then approaches till the risk is there, so the process will be continued. There are various techniques through which we can do risk management. The first technique is risk avoidance. We should not do those kind of activities. We should not do those activities in which risk is involved. So try to avoid doing those activities in which risk is involved. So if you can do it, that's the best way. Otherwise, if you can't avoid the risk, means if you are doing something and you know there is risk, suppose you are giving credit to some person and you don't know whether the person will return that money or not. You are not sure about that. Okay, what if he'll do fraud? What if he'll not return money to you? So in this case, you cannot avoid the risk, but at least you can reduce it. You can have some contract, some paperwork signed so that the person will not be able to do fraud with you. Okay, if you are not able to avoid it, reduce it. Risk sharing, you can share it with others. Okay, you can do activities in partnership so that not just you are responsible for that, you can share the risk with others. And then finally comes risk retention. If you can't do any of these things, if you can't avoid it, you can't reduce it, you can't share it, you have to bear the risk. Means you have to accept it and you have to find some solution for that. Okay, if you can't avoid, you can't reduce, or you can't treat that risk, just try to find out some solution and accept it. Accept that risk if you can't avoid. Now, coming towards types of risk, there are various types of risk, like interest rate risk is there. Interest rate risk, that means if you have given loan to someone, just like I said in the previous example, suppose a person has taken loan from your organization and there is a risk whether that person will be able to return that loan or not. So interest rate risk is there. If there are arrears, how will you manage it? Okay, so a risk is involved. Market risk, that means stock securities market are there. What happens there? Prices go up and down, price fluctuations are there on the basis of various economic conditions. So there are price fluctuations. So that is market risk. If you have invested your money in the market, you don't know whether the price will go up or it will go down. Then inflation risk. Inflation risk, that means the price of any product or any asset, any instrument, it increases. Time by time it increases. Okay, the price of a commodity increases. Suppose you have invested 2 lakh rupees. Today you have invested 2 lakh in a particular asset, and after 1 year you are going to get 2,50,000. That means 50,000 will be your profit. Okay, but inflation says that the value of money today, the money whose value is 2 lakh, after 1 year its value will become 3 lakh due to inflation. But you are going to get only 2,50,000. You are going to get only 2.5 lakhs. So there is loss now. So inflation risk is also there. Business risk is there. In business there is always risk in profits, losses. You don't know whether if you have started a business, you don't know whether you will get profits or losses, and up to how much extent, up to what extent you will get profits or losses, that also you don't know. So there is risk. And you can predict, but you cannot actually know. Financial risk. Okay, if you have taken loan from somewhere, so the more loan you have taken, the more interest you have to pay. No matter, okay, if you have taken loan from anyone, from any organization, so they are not bothered about your profits and losses. You have to pay interest to them, they will receive interest. You have to pay them interest anyhow. Okay, how you are doing it, that's up to you. So that's financial risk. And last is liquidity risk. If in the short term you are not able to manage money, okay, you are not able to complete your short term money requirements, short term finance requirements, so liquidity risk is there. Okay, you will not be able to run your business. Now, importance. Why it is important? Everyone should manage risk. Without risk, we cannot get succeeded. Okay, if we want to do something big, if we want to get huge success in our life, we have to take risk. Okay, or if we are not in a condition to take risks, then we cannot have huge profits, we cannot have huge success in our life. So we have to take. Makes jobs safer. If you are well aware about the risks associated with all the activities in your business, then it makes your job safe, because you are aware. That means you are well prepared about that and you can manage it properly. Project success. If you are doing any activity, then also if you are regularly monitoring the risks every now and then projects will be succeeded. Reduces unexpected events. If any unexpected events are there, that also you will get to know, because you can find out the possibilities, what can be the risks involved in it. And then decision making, it helps in decision making, taking various important decisions. Now, risk management, last concept is there. Adopting a decision due to minor risk aspect, unexpected results. Okay, suppose you have analyzed a particular activity, a particular project, that there is going to be huge risk, and or there is going to be a minor risk. Okay, and due to that risk factor, you have changed your decision. Earlier you were going to do that activity, but now you are not going to do that activity. You have changed your decision, you have changed your strategies. So due to only that risk, you have changed your complete decision, complete strategy. So that is not going to work, because then again that planning and everything is required. So there are techniques you can use that. Either try to avoid the risk. If you can't avoid, reduce it. Or if you can't reduce, accept the risk and try to find out its solution. Then analyzing risk through past opinions. Okay, we are not expert, we don't have experience, so we don't know how to manage risk. So we are seeing how do others managing it, but not every past opinion is good, because suppose the other people are also managing the risk, but they are not able to, but that situation is different from ours, because suppose today we are in some situation that is different from that past situation. Risk is similar, but the situation is different, so we can't apply that same technique in our situation. False belief to identify each and every risk class point. That means sometimes we believe that we have identified everything, but actually that's not going to happen. Okay, so we have to identify and we should not be overconfident. We should not be overconfident in risk management. Okay, so in emerging areas, I think I have covered risk management. Now two more concepts are left: behavioral finance and financial engineering, that we will see in the next sessions. Thank you so much for watching.